we're doing all this, but I don't have any, free capital floating around to go invest in that next deal. Or maybe I want to invest in a note, right? But I don't have any capital. Well, in this phase, we call this asset repositioning. Over 90% of Americans have money in two places. It's in government sponsored qualified plans, right? Where the government's telling you when you can access your money and how much you're going to take out, what the tax rate is going to be, or it's in trapped equity in their primary residence. Right. So let's get a little bit creative here and say, okay, maybe I can reallocate some of my qualified money into something like a self directed plan. And now I can use some of that capital to go invest in notes. I can invest in a next real estate asset, and kind of restructure that to actually reduce your risk of having all your assets aligned to the market risk and volatility that's there, and also start to create some income, right, in another asset class. And then the same holds true, like, if you can borrow money at 8% from the bank, for on your, you're paid off half of your house. I mean, it's a myth to try to pay off your house, right?
Yes, it
That's
is.
right. It doesn't make sense anymore in this debt-driven society that we're in. So you can get bank money at say 8% today, and then I can go leverage that and then put that into maybe something that's safe, like a note, a debt instrument, a credit, and you can make a nice arbitrage on that. And by the way, here's two other benefits. You increase the mortgage interest deduction you have, so you make some improvements on your tax, and now you've actually taken more risk off of your back and given it to the bank. Because if you own that asset, you're actually more susceptible to creditor risk. And
Mhm.
now, if you give it back to the bank, right, the bank actually has more risk there. So there's some actually really nice plays, again, if you start thinking creatively and outside of the box of conventional thinking.